Welcome back. We are jumping right into an analysis report on NVVE Holding Corp, NWVE, focusing on that critical $3.50 support level after its 1 for 40 reverse split.
Yeah, and this is a strong piece of work to start with. It defines the trade really clearly, and it does a great job of integrating that fundamental catalyst from Korea, which a lot of people might miss.
Exactly. So let's get straight into how we can make this setup even more robust, especially with the title in mind, holding key support.
Right, because with the kind of volatility you get from a reverse split, the logic has to be absolutely unassailable. We need to really weave that fundamental conviction into the technical case.
Okay, so let's start right there. The analysis points to the NVVE Volt partnership in Korea as a hidden catalyst. A big deal, right? Opening up the Asian energy market.
It's a huge deal, but the analysis needs a stronger, more explicit connection between that long-term fundamental story and the immediate short-term trade.
Okay, so we have this huge narrative, but it's sort of walled off from the actual trade idea.
That's it exactly. It's siloed.
And where does that structure start to break down for you?
Well, the report introduces this really exciting growth story, this entry into Asia. But then it almost immediately pivots and calls the trade a high-risk, dead cat bounce.
Mm-hmm.
And the weakness there is that separation. It makes the fundamental news feel a bit like optional hype.
Right, like just some extra flavor instead of being part of the core thesis.
Precisely. It's not treated as a structural factor that actually reinforces that $3.50 floor. The analysis should be arguing why that specific level is a compelling entry point, not just a random line on a chart.
I see. So if the catalyst is that strong, it shouldn't just be a footnote. It should be the very reason you have conviction at that price.
That's the move. The suggestion is to use the Korea partnership as the justification for why the $3.50 to $3.60 zone should be seen as an entry for, let's call it smart money.
Okay.
For people who recognize that undervalued growth potential, not just traders playing a quick technical bounce off some short covering. It redefines the support level from something arbitrary to something fundamentally validated.
But doesn't that risk changing the whole focus of the report? I mean, it's pitched as a quick, actionable trade. A technical bounce trader might not care about a 5-year projection for Asia.
That's a fair point. A really good challenge. But we can integrate that conviction without slowing down the trade. It's about making the analysis more layered.
So how do you do that? Give me a concrete example.
Okay, so instead of just mentioning the news, link it directly to a volume trigger right at that support level.
I see.
The analysis could suggest monitoring for specific high-volume days and argue that if big volume shows up right around $3.50, it's far more likely to be driven by fundamental conviction, the Korean news, than just algorithms covering shorts.
So we're not just looking for any bounce. We're looking for a validated bounce. What kind of data would you even track in the next 48 hours to see that?
You'd look for proprietary flow data, things that signal unusual accumulation right at that floor. The analysis could literally say, if we see 3 consecutive high-volume hourly candles holding 350, we assume fundamental players are stepping in.
Okay, that's actionable.
Or you could even outline a tiered strategy. Phase 1 is the dead cat bounce to $4. Fine. But holding past $4, that requires a specific confirmation related to the Korea deal. It makes the whole strategy smarter.
That's a powerful shift. You've just elevated the 350 floor from a simple stop loss to a really meaningful entry point. But that conviction also brings up the risk. Let's talk about the reverse split itself.
Yeah, let's get into it.
The argument in the report is that this 1 for 40 split caused a final washout, and that $3.50 is the critical support that emerged from it.
Right, and for maximum rigor, the analysis has to dig deeper and contextualize that $3.50 support within the structural risks that made a 1 for 40 split necessary in the first place.
Because a split that drastic isn't just a technical event.
Not at all. It's an extreme measure. The analysis can't just mention it as a cause for selling. It has to grapple with the implications of the corporate distress behind it.
So what's the key factor here that you feel is being underestimated?
Okay, so the analysis correctly identifies the aftermath, the sell-off, the washout. That's good. The weakness, though, is that it focuses almost entirely on the $3.50 floor without really grappling with the why.
The underlying corporate health issues?
Exactly. A 1 for 40 split often signals serious debt, listing compliance problems, or that they desperately need to raise cash. So just treating $3.50 as a psychological floor might really underestimate the volatility.
Or the potential for immediate dilution.
For sure. If the underlying financial problems are still there, that floor could easily break.
Yeah, if you ignore the why behind the split, the risk assessment feels a little fragile. That line in the sand needs more justification than just a chart pattern.
Absolutely. So the suggestion here is to strengthen that definition. Compare the psychological $3.50 support with the historical equivalent 52-week low, which the report cites as $3.21.
Okay.
Then you can say if $3.50 is breached, the report should immediately anticipate the consequences of a deeper break. It justifies the tight stop with something much more meaningful than just a pattern failure.
That makes the downside much more tangible. So what would be the analytical takeaway if $3.50 failed and the stock started heading towards that $3.21 equivalent low?
The implication would be that the market sees the reverse split as purely defensive. It means a total loss of confidence that even the great news out of Korea can't fix.
So a move to $3.21 would be confirmation of a real structural breakdown.
Yes. It means the short-term trade thesis is completely invalidated. At that point, the company is likely being valued at its absolute floor before, something catastrophic like restructuring or major dilution.
Okay, can you give us some specific ways to integrate that kind of extreme risk without turning the whole analysis report into a doom and gloom piece?
Of course. You can state that $3.50 is the critical level for short-term momentum traders. That's their stop loss for this specific bounce play.
Got it.
But then you advise that below $3.50, the analysis is now looking for volume confirmation near the $3.21 low. That becomes the absolute line in the sand, the point of no return.
So you're creating two different risk levels for two different outlooks.
Exactly. And to improve the logic, you could even add a brief counterargument. If the market smells high debt or an imminent financing, that $3.50 floor means very little. The analysis should then suggest what to look for, like volume completely drying up, to confirm that the weak hands are truly out.
That level of detail adds so much rigor. It shows the analyst has really thought through the worst-case scenario. Okay, so for our final point, let's talk about tone. The report uses this very vivid, high-energy language. Things like being an opportunity hunter, looking for a massive gap fill. It's very engaging. But then it's contrasted with the final verdict. This is high risk, high reward, keep your stops tight.
Right, and the powerful, contrarian tone of the analysis needs to be carefully calibrated so it doesn't analytically overshadow that crucial high-risk warning. The engagement is great, but we have to make sure the reader respects the risk just as much.
The language is great. I mean, we don't run, we hunt. That pulls you in. But when you put that right next to the tight stop warning, does the tone accidentally undermine the risk?
It can. The weakness is that this dramatic framing risks minimizing the analytical weight given to the failure scenario.
I see what you mean. It's lopsided.
Yeah. The analysis spends a lot of time detailing the potential 10-15% gain to fill that $4.07 gap, but way less analytical time on what actually happens if $3.50 fails. It makes the risk side feel less developed than the reward side.
So the suggestion is to give the downside the same level of specific detail and urgency as the upside target. It's about defining what a trap scenario actually looks like beyond just, price breaking $3.50.
Exactly. A mere break of $3.50 could just be algorithmic noise. A trap is sustained failure. It means you have to define the mechanics of the downside just as meticulously as the upside.
So by defining that trap so explicitly, are we risking overwhelming a high-speed trader, or are we just adding necessary discipline?
Oh, it adds discipline. 100%. High-risk trading absolutely relies on predefined conditions for your entry, your exit, and especially for when you're wrong.
Right.
And you can add this detail without slowing it down. For example, the analysis mentions the RSI suggests a bounce is statistically due. Great. Contrast that by explaining what would negate that RSI signal.
Like what?
Like stating that if volume fails to show up after the open, or if you see sustained selling pressure even while the hourly chart is oversold, then the bounce thesis is invalid. That's a trap.
That's specific and immediately actionable. I like that.
And one more thing. To balance the plan, dedicate a specific point to defining the wait scenario. Right now it just says, if it breaks below, we wait. That's too vague.
Yeah, wait, where? Wait for what?
Exactly. The report should explain where to wait. For instance, waiting for consolidation near that 321 structural low before reevaluating. It provides a clear, non-emotional safety net for a high-risk call, and it makes the entire strategy more complete.
This has been a really focused breakdown.